Welcome to this month's tax tips. This month we're going to focus on the tax changes that were announced in the recent mini budget. It wasn't really a mini budget, there was a huge amount of announcements made, and so we'll dive straight in. The first place to start is corporation tax. As many of you will be aware, corporation tax was set to increase from the 1st of April 2023. And we've been having a number of discussions about how that's going to impact businesses and what can be done about it. Well, all those discussions can be shelved because those changes are no longer going to take place. Corporation tax is going to stay at 19% for all companies, regardless of the level of profits, and there is no end date attached to that. So 19% is just going to continue as we are now. One additional announcement, the annual investment allowance, which allows tax relief for purchases of plant and machinery, vehicles such as vans. The annual investment allowance is currently £1 million, but it was set to reduce to £200,000 from the 1st of April 2023. Well, that reduction has also been scrapped, and the £1 million allowance will remain in place again for the foreseeable future. There's now no end date to that level. One thing that is going to end is the super allowances. Super allowances give capital allowances at 130% for anything that plant and machinery and vehicles, again, that are purchased brand new. That measure is set to end on the 1st of April 2023, and no announcements were made about that, so we assume that will continue and that will end on the 1st of April 23. Income tax changes to look at next, and the first one is national insurance, because that's the first thing that will change. As we all know, national insurance was increased for both employees and employers by 1.25%, and that was back in the 6th of April. That increase will be scrapped, and that is an immediate change that will be coming to force on the 6th of November 2022. The change is effective for both employees and employers, so the employers and I will go down as well. There's no change to the uplifted thresholds that were announced as part of the change. So a double whammy for everybody, really, with national insurance rates going back to what they were, but the thresholds at which you start to pay national insurance staying at the increased rates. When the national insurance increases were announced, the employment allowance was also increased from £4,000 to £5,000. That change is unaffected, and so the employment allowance will stay at £5,000. All of this means that there's no need for directors to change their salaries that they're paying themselves this year. The effect doesn't impact on any of the advice that we've previously given, so you shouldn't change anything there. The only change that you need to be aware of is that the national insurance rates must change on the 6th of November. And so it's important to make sure that your payroll software providers are able to implement that change in this very short time frame they've been given. One odd knock-on effect is that when we come to produce P11Ds for this income tax year after 5th of April 23, there will be a slightly odd hybrid employers NI rate that applies to P11D benefits, and that rate this year will be 14.53%. That's because the increased employers NI percentage of 15.05% applies from 6th of April to 6th of November, and then they revert back to 13.8% from the 6th of November through to the 5th of April. And so we have to average that rate out across the year when we produce the P11Ds. Carrying on with income tax, it's firstly important to note that all of the income tax changes that were announced will apply from the new tax year, 6th of April 2023. And so all of the tax rates that were increased on the 6th of April 22 still apply for 1 year only in the income tax year that we're currently in, the year that runs to 5th of April 23. Now, there was a number of significant changes announced. For small business owners who take the vast majority of their remuneration as dividends, there was good news. First of all, the increase in dividend rates that mirrored the national insurance change, with 1.25% being added across the board to all the dividend tax rates, has been reversed. And so from 6th of April 23, we will revert back to income tax rates of 7.5%, 32.5%, and 38.1% on dividend taxes. although the 38.1% rate actually won't revert back, because as well as the reversal of the income tax charges with the national insurance threshold, they've scrapped the top rate of tax. So for employed earners, that meant you paid 45% income tax on earnings above £150,000. For those taking dividends, you paid 38.1% above £150,000. That top rate is scrapped now, so 32.5% applies to any dividends in the higher rates, and that is now unlimited. Carries on above £150,000. In addition to these changes, the basic rate of tax will be reduced from 20% to 19%. Again, that applies from the 6th of April. And that, of course, applies to any income that attracts the 20% income tax rate. So salaried earnings, rental income, and interest. It doesn't mean that there'll be a further reduction in the basic rate of tax for dividends. That's going to stay at 7.5%. Some other measures that have been announced, the stamp duty residential threshold has increased from £125,000 to £250,000 with immediate effect. So that means that on any residential purchase, you don't pay stamp duty until the value of the property goes above £250,000, a doubling of that relief. There's been some changes, fairly significant changes, to the Seed Enterprise Investment Scheme, both for investors and companies attracting investment. The investor limit has been raised to £200,000 now, so investors can put £200,000 of investment and attract this valuable relief, where they get 50% tax relief on the amount that they invest. And the amount a company can raise through the scheme has also been increased to £350,000. So again, this is part of the government's drive to encourage growth in the economy and attract investment from private investors. One thing that has been changed that I think will be widely welcomed across a certain aspect of our client base is that the Ir35 changes introduced in 2017 and more lastly in 2021 have been reversed. These changes meant that the company who was employing or taking on the services of a contractor had to assess whether they fell within IR35 and decide whether the individual concerned should be treated as an employee or could be treated as a subcontractor. Very different tax treatments. If you're treated as an employee, then of course tax and national insurance has to be withheld at source. That responsibility will revert again from April 2023. And so it will revert back to being the subcontractor's responsibility to assess whether they fall within IR35 and then to self-manage the tax deductions appropriately. The end user, the company who is contracting with the subcontractors, will lose that responsibility for having to make the determinations. And that's it in terms of the changes. In terms of a quick tax tip this month, of course, there's been an unprecedented level of change and a massive raft of tax reductions. It's important to note that those tax reductions apply from April 2023, the vast majority of them, apart from the national insurance change. And so where possible, we're now going to be looking at whether we can defer income from this tax year into the next tax year, because all the tax rates are going to be lower next year than they are this year. Of course, you've got to pay yourself and meet your living costs. But if there's any excess income you're thinking about taking this year, it's best to take it next year. If you've got any questions about structuring your remuneration and extracting profits from your business, of course, contact us with any questions. We'll be doing our best to get round and talk to as many people as we can. The tax pre-year-end meetings, of course, are going to be vital again this year. But if you need any urgent assistance, don't hesitate to get in touch.